All right, everyone. So in this video, I will be talking about stop losses and profit targets. Now, I know that a lot of you have probably already seen a video of mine talking about stop losses, but I decided to remake the video and just sort of refining a little bit and hopefully clear up a few things that I wasn't able to clear up in the last video. I also added profit targets, which is basically the same thing you would target as where you would put a stop loss at. But we'll get into that right now. Okay, so this is very important. If you want, I won't read through this. I'll just let you guys pause the video and you guys can read through it on your own. But it's very important that you read through this, okay? All right, cool. Okay, so we are going to be using support and resistance levels. So support represents a price level at which an asset tends to find buying interest, preventing it from falling further. It's like a floor that supports the price. Resistance, on the other hand, is a price level where selling pressure typically emerges, preventing the asset from rising further. It acts as a ceiling, limiting price movements. These levels help traders identify potential entry and exit points, as well as gauge market sentiment. So if you're a support and resistance trader, you can simply put your stop loss at one of your support areas that you think is best. I would recommend backtesting anything that I am showing you, so that way you can have a better idea of whether it works best or not. And for your target, you can simply just target another area, or in this case, you would be targeting an area of support. So in this example, we have my stop loss set at this resistance level here, and then you could have targeted this area of support down here. And as you can see, price ended up hitting TP. Real easy, guys. Okay, so now we have rounded price levels or bank levels. So rounded price levels, also known as bank levels, are price levels that are easily divisible by 100. Now, real quick, some people have different ways of finding or determining bank levels. This is just an example here, okay? They often end with 2 or more zeros and often serve as strong support or resistance areas in trading. For example, the 120.00 as opposed to 119.97. So you just round it up, right? Making it easier to identify on price charts. Traders pay attention to these levels because they often represent areas where institutional traders, like banks, have placed significant orders. When the price approaches a rounded price level, it can act as a psychological barrier, attracting buying or selling interest. Traders use these levels to make informed trading decisions about entering or exiting trades. So, as you can see, you could have entered here, stop loss at this rounded bank level, and you could have targeted this area down here, right? Another zone, easy money, easy money. There's nothing crazy about it. Now, do I personally use rounded price levels or bank levels? Not really. Like, honestly, ever since I moved to more of an SMC ICT type of style, I've never ever had to use this. Now, I'm not saying that doesn't work. It's just, for me, I like trading the way I'm trading now, and it's worked pretty darn good. And I would personally recommend anyone that is currently trading these kinds of levels or styles to simply move on to more SMC/ICT approach, just because it's a little easier. And to me, it just makes more sense. But if this is working for you and you're making good money with it, then just stick with it. Okay, so we got Fibonacci levels. So the Fibonacci tool is a technical analysis tool that helps traders identify potential support or resistance levels based on mathematical ratios derived from the Fibonacci sequence. It can be used to set stop loss levels by placing them at Fibonacci retracement levels, which often act as key support and resistance zones for price movements. Remember, fibs work best when trading with the trend. Well, anything works best with trading with the trend. But you don't have to use these specific fib levels that you see here. It can be any fib levels that you want to use. Just make sure you backtest them to make sure that they work best for you. But yeah, you can set your stop loss at the fib level that you have in mind. And if you have any fib levels like down here, right, you can see this -27. If it's part of your trading plan, you could target one of these kinds of levels, right? And as you can see, price ended up coming down, and it actually eventually ended up touching the -27% level. All right, so that's another way that you can do it. ICT has something called the optimal entry levels. You guys can look those up. I also made a video on this. It's on my playlist. So start with the first video and move up from there. All right. Okay, now we have order blocks and breaker blocks. So if you don't know what order blocks and breaker blocks are, look at my playlist or finish the playlist. If you're on the beginners playlist, it'll explain everything on there. Please look at the playlist and make sure you finish the videos, because it's very important and crucial in order for you to understand what it is that I'm trying to explain here. Okay, now as you can see, I put my stop loss at the end of this order block, and I could have targeted the order block that was up here a little higher. That would have been TP as well. And as you can see here, I have a breaker block, right, entered as soon as price rejected off the breaker block, and I could have targeted another order block or breaker block on the higher time frame. Point is, you can use the very things that you're using as a stop loss, or the very concepts that you're using as a stop loss, and you can flip them around and use them as part of your take profits. It's pretty easy stuff. All right, it's not hard. Open up a chart and see if you can replicate this yourself. All right, next is fixed pip size. So if you are planning on using a fixed pip size, I would definitely backtest this, because I personally don't find this very useful. But if you are going to use it, definitely backtest. All right. So using a fixed pip stop loss involves setting a specific distance measured in pips. Now, if you're using futures, I believe they're just handles. They work a little bit different. I think they're also called ticks, but you might want to look that up. From your entry point as your predetermined exit point if the trade moves against you. Now, there's a pro to this though. It's very simple, right? It's straightforward and easy to implement, making it suitable for traders who prefer a clear and defined risk level from the start. Now, the problem is it's its lack of adaptability. One major drawback is that it doesn't account for market volatility or the price action that you're currently seeing. So what might be an appropriate fixed pip distance in one market condition may not work well in another. This lack of adaptability can result in premature stop outs or setting stops that are too wide or too tight for the current market conditions. Very, very important. But just as you have a fixed pip stop loss, you can also have a fixed pip take profit. So as you can see here, the stop loss was at 5 pips and the take profit was at 5.1, but you could have just set it at 5, it would have been just fine. But again, please backtest this idea. Don't just take my word for it. Literally backtest everything that I'm telling you or giving you. Okay, otherwise you're going to have a very hard time and you're going to lose a lot of money in the live market. All right, so fair value gaps. If you don't know what fair value gaps are, definitely look at my video for it. Okay, it'll explain what fair value gaps are in depth. All right, so yes, you can use fair value gaps. Very, very easy, very simple. If you find an entry, right, let's just say you found price reacting off of an area here, or for whatever reason you just decide to enter here, you can set your stop loss at the nearest fair value gap, at the highest portion of that fair value gap, which would be this edge. And then you can target the nearest fair value gap or the furthest one, but you don't want to go all the way to the bottom of it. Keep it in the closest area of the formed fair value gap, which is right here in this example, right? So let me actually zoom in for you so I can show you what I'm talking about. Notice how I didn't put the stop loss under here. I put it right here. I would recommend you do that. But for the stop loss in this fair value gap, I put it on the furthest area away from price or from my entry. And as you can see, TP smashed. All right, so now we have swing highs / lows and fractals. And by fractals, I mean like fractal highs and fractal lows. So highs and lows provide a clear and objective method for setting stop losses based on recent price levels, which many traders find easy to implement. Be cautious of quick changes. When you use previous highs and lows for stop losses, there's a chance that the price might briefly go below a low or above a high and stop you out and then return to its intended direction. In other words, you might get stopped out because price might be seeking liquidity at the high that you placed your stop loss at. To avoid this, it's a good idea to use extra analysis to double check your choices before setting your stop loss. Okay, so real quick, let me zoom in. Okay, so recent high or fractal high, and yes, you can use type 1 and type 2 structure. Now, this is actually an old video, that's why you see 2023. So I released this video a long time ago. But anyways, as you can see, I put my stop loss above this high, and check it out. Price ended up going down all the way to this fractal low. TP smashed, right? Really easy, really simple stuff. And on this example, as you can see here, we have a normal high, so previous swing high, These types of previous swing highs or lows have already been created and are swing points for price to react off. So same thing here. I entered on this area, right? Set my stop loss above the most recent high. And what did price do? Came down and ended up hitting TP again as well. You get the picture, right? Open up a chart, see if you can figure this out, see if you can find areas where you can replicate this. And again, if you have any questions, send them in the Discord. The Discord is for free, okay? I don't charge for the Discord. All right, so I know a lot of you are going to ask, what about indicators? Can I use indicators for my stop loss? Now, here's the thing. Indicators can be valuable tools for setting stop loss levels and trading, but it's generally recommended to use them in combination with other indicators, especially if your entire trading strategy relies solely on indicators and not price action analysis. So if you are going to use indicators, please make sure that you have your price action analysis down if you're trying to do a combination of both things. But if you're using indicators as your only method of trading, then you definitely want to make sure you back test them, because trading with indicators is a little difficult in my opinion. There is a guy by the name of David Tech, I think, or Trading with David Tech. If I find the channel, I'll link it down below. He does an amazing job when it comes to trading with indicators, and I highly suggest you look up his channel, okay, if that's something you're interested in. Now, here is why. Confirmation. Using multiple indicators can provide confirmation of a trade setup. If different indicators all align in the same direction, it strengthens your confidence in the trade, including where to place your stop loss. Next is reduce false signals. Relying on a single indicator can lead to false signals. So the problem here, guys, if you're trying to combine price action with indicators for your stop loss, you might want to add another indicator to confirm the one that you're using for your stop loss. I know it's a big deal. Now, causing premature stop outs. Combining indicators helps filter out these false signals, leading to more accurate stop loss placement. Comprehensive analysis. Trading isn't one size fits all, and various indicators excel in different market conditions. Combining them allows you to adapt to changing market dynamics. Now, some commonly used indicators for stop losses include moving averages, RSI, Bollinger Bands. In summary, while indicators can be useful for setting stop losses, they should ideally complement each other in a well-rounded trading strategy. Relying solely on indicators, especially without considering price action, can increase the risk of false signals and stop outs. Now, you don't have to only use these three. There are many other indicators that you can use for your stop losses. These are just the most generally used, okay? But I really would much rather you stick to price action, in my opinion. Now, for the final verdict, which is better? There is no single best stop loss or take profit method in day trading, because the effectiveness of a stop loss depends on various factors, including market conditions, trading strategy, and individual preferences. What works well in one situation may not work well or may not work as effectively in another. Day traders often need to adapt their stop loss methods to suit each unique trade, making it hard to declare one method as universally the best. It's essential to be flexible and choose stop loss techniques that align with the specific context of each trade to maximize your chances of success. So choose what's best for you. Backtest, ladies and gents, backtest, backtest, backtest. You already know that is my favorite thing to say, because the more data you have, the more sure you can be of relying on your strategy, okay? Please backtest. Now, to finish off this video, I've got some indicators that I want to show you first, and they're all hyperlinked. You can download all of my presentations. They're all going to be linked in the description below. Every single video I make, I will always leave a link to the presentation themselves, so that way you guys can keep them and look back into them. Now, as always, before I leave, I like to leave you guys with a little bit of wisdom. This is from Proverbs 11:2. When pride comes, then comes disgrace, but with humility comes wisdom. As always, guys, thank you so much for watching my video. Thank you for taking the time to look at my content. I really appreciate it. And if you appreciate what I'm giving you, give me a like, give me a subscribe, and let me know down in the comments if there's something else you want to see. Join the Discord. It's free. I'm not telling you any courses, and I never will. And I also have some free signals in the Discord. So with that being said, I will talk to you guys soon in the next one. Peace.